Welcome to Ab India Karega Invest. Today, our session is actually one that is very close to my heart. Mind over money. How can biases affect your investment decisions? So, one of the less talked about investments aspects of investments is that we all sit and discuss about things like if you're investing in mutual funds, we talk about things like asset size and different kinds of mutual funds, equity, debt, and so on. And when you're talking of stocks investing, we often talk of what we'll do, different strategies. We'll buy when this happens, we'll sell when that happens. But one aspect that somehow it seems that we don't talk enough about is, will we be able to do exactly as we say? Or will we be affected by things that we don't realize will affect us? So these psychological biases affect all of us, and being aware about them is an excellent strategy to deal with them. Although it still does not guarantee that we'll be able to successfully deal with them. Even the awareness does not fully help us. But surely, at least being partially aware of these biases are what I would consider absolutely essential to investing. And not just that, these biases also tend to make our other decisions in life much better, not just investment decisions. So to talk to us about this and a lot more, we have one of the biggest names in our industry, Mr. Hariiharan. He's the segment head, learning and development from Axis Mutual Fund. I'm sure everybody knows how well Axis Mutual Funds are doing, be it their flagship blue chip fund or others. So now I'll call Mr. Hariiharan here, and he'll present and he'll talk about mind over money. Mr. Hariiharan, all yours.
Yeah, thanks, Shikhar. Let me just share my screen. All right, so I hope the screen is visible.
It's visible.
Okay, thanks. Good evening all. Welcome all of you to this very interesting session, which is called as Mind Over Money. And as Shikhar was saying, this is a topic which is very, very critical and important, but unfortunately not talked about. So we'll try and understand certain aspects of the way we take decisions in our life today. My only request is that I will ask you and give you certain situations. Please try and respond to these situations as quickly as possible so that it becomes interactive, so that you also enjoy the session, and it also gives me the required energy to conduct this session, right? So quickly, let me ask a very simple question to begin with. Let's assume that I give you two choices. The first choice is that I give you 100 rupees today. The second choice is I give you 101 rupee next week, exactly 1 week later. Which one will you pick? 100 or 101? So you can type quickly. If you're selecting 100, type 100. If you're selecting 101, type 101. And let's see what your responses are. Shikhar, have you got some responses?
I don't think so. This is being aired on YouTube. The comments would be on the YouTube. They wouldn't come on Zoom chat. So I think we'll have to do it without that. You can probably state. We did get a lot of responses.
Okay.
So I think in this case, you can just quickly state that what you observe is commonly observed.
Okay, yeah. Okay. So typically, when we ask this question, I have found that 75 to 80% select the option which is 100 rupees today, vis-a-vis 101, which is after 1 week. Okay. So we'll understand why this happens. So broadly, we will understand in today's session how our mind works, how we take decisions, because each moment we are taking a decision in our life. And we'll also discover some of our own biases today. And finally, I will try and show you how a powerful strategy can be used to overcome these biases. All right. So let's understand this. Essentially, what I'm trying to say is that inside our brain, there are two systems that operate. One is called as system 1, the other is system 2. Now, system 1 is a fast thinking system in the sense that it is very quick to respond. It is very instinctive. It does not think, it just responds. And typically, when you look at system 1, it can only do those tasks where there is very little effort required. But very important point is that system 1 is emotional in nature. That's very, very critical. System 2, on the other hand, is a more rational system. It is something like this. If I give you a situation, you think over it and then you respond. So it is more logical. It is much slower as compared to system 1. And because it is logical and it is rational, typically it has been observed that our system 2 decisions are by and large the right decisions that we take. But system 2 requires effort. And this is where the challenge is, because as human beings, our predominant nature is to do tasks without taking much of an effort. And therefore, if you actually look at it, even though both system 1 and 2 are present inside our system, you will predominantly see majority of us would be using system 1 for most decisions that we take in our life, including investments. And as I said, the system 1 decision is an emotional decision, and emotions can sometimes fail us. Okay, that's important to keep in mind. Now, what also happens, because both the systems are present inside our brain, okay, it is like a mother-in-law and a daughter-in-law staying in the same house. You can imagine the situation, okay? So there's a cold war between the mother-in-law and the daughter-in-law. So there's a cold war between system 1 and 2. Both are present inside your system, and both of them are saying, "Hey, wait, listen to me." System 1 is saying, "Before you respond, I will give you the answer. Wait, take my response." System 2 says, "Hey, wait. System 1 is very fast. He will not think. He will just respond." System 2 says, "Please wait. Let me think over. Let me respond." But as I said, in this conflict, what happens predominantly it is system 1 which takes the decision most of the time in our case. And because of this conflict that happens inside our brain, this leads to what we call as biases. Okay. In investments also, there are two kinds of biases. One is an emotional bias. The other is a cognitive bias. But let's understand what these biases are. So I will give you situations again, since I will not be able to access it, but you can keep responding on the YouTube chat. But I will keep the situation. The first situation is this. Let's imagine that you have gone to a entirely new city. This is the first time that you're going to that city. So you go to your hotel, freshen up, and you're feeling hungry. But you decide that you will not want to have lunch in this hotel where you're residing. So you're just wanting to explore. You say that is lunchtime, any which ways I can explore the city as also. So you go out on the streets. You try to find a restaurant, where you can have food. So you walk for a few minutes and then you come across two restaurants which are close to each other. Okay, one of these restaurants is empty. The other restaurant is full. Now, think about the situation. You're going to this particular city for the first time in your life. You know nothing about the city. Which of these restaurants would you prefer going and having your food? If it's empty, you may want to type E. If you feel it is the full restaurant which is full is where you want to go and have your food, you type F. Okay. So
we'll just wait for the answers to.
Yeah, sure.
Yeah. Just give it like 5 or 10 seconds.
Sure. No issues.
So we're seeing F, full.
Full. Okay, absolutely. And this is the typical expected behavior, Now let's understand why this happens. Why do we go and enter the restaurant which is full? Now what we are seeing is that the mind tells us that we are going to this city for the first time. We don't know anything about this particular place. So we go purely by observation. And what is it that we are observing? We are seeing that there's a restaurant which is empty. There's a restaurant which is full. I don't know anything about the city. I don't want to take a chance. So let me enter the restaurant which is full, because if this restaurant is having a lot of these customers who are sitting and having food, it means that this restaurant is serving good quality food and the service is also good. So I rely on information which I observe. And typically when I see that there's so many people having food at that particular place, the assumption is this might be a good place to go and have your food. This in investment is what we call as the the herd mentality. This is also called as a social proof. Now, what do we do in this? We try to copy the behavior of others. If there are so many people who are doing the same thing, we feel it is the best thing to do. And therefore, we simply blindly follow them. Let's look at some examples of herd mentality in investments. We have typically seen this, across different market cycles. Most of the inflows that come into mutual funds or equities, typically happens when the market is at a high level. Okay, which means everybody is going into equity. I also want to get into equity. Everybody is going to gold. Let me also go to gold. Two, I have seen a lot of people simply copying the investments of their relatives or friends or office colleagues. So I see that my colleague has invested in ABC mutual fund scheme. I also invest in the same mutual fund scheme, right? Please understand that each one of us are very, very different in terms of the risk appetite that we can take. Our investment time horizons could be very different. Our goals could be very different. And therefore, blindly copying somebody else's investments is not the right thing to do. Okay, so that's herd mentality. That's the first bias. Let me give you the second situation. So all of us have been tied at home, thanks to COVID for the last almost a year now. And it's been high time since we have gone to a theater and gone and watched a movie. Many of us would have we got entertained, through some of the OTT platforms like Netflix. But there is a different kind of excitement in going and watching a movie in the cinema hall, right? So let's assume everything is open now. You're free to go to a PVR cinema or any multiplex. So what do? You decide that this Sunday you're going to go and watch a movie. Now it's a digital age that all of us are living in. So you book the tickets online. And let's assume that you have spent 1,000 rupees to book the tickets. You get an online receipt, which is delivered to your email address. You take a printout of this online receipt so that you can carry it as a proof at the cinema hall. Unfortunately, what happens is that the mail which contained the online tickets or the receipt gets deleted accidentally by you. So there's no online proof that you have got. You have got only this physical paper that you're going to carry with you. So you fold it nicely, keep it inside your pocket, and you go on Sunday to the PVR hall. Now, when you reach the security, so the security is asking you, sir, madam, please show me your tickets. So you put your hand inside the pocket only to realize that that online receipt is missing. You don't know where it has gone, but it is missing. So the security guy says, sir, madam, you don't have a ticket with you. Please go to the ticket counter, spend 1,000 rupees, get the tickets, and I will allow you inside. Now tell me, how many of you would spend 1,000 rupees again, watch the movie? If you're going to watch the movie, type yes. If you're not going to watch the movie, type no. And let's see what is the kind of response.
Okay, we're waiting. No. Most of the answers are no.
Absolutely. So again, this is the expected behavior. Let me give you a different situation. Again, you're going to go to PVR, but the situation is slightly different in the sense that you're not booked the tickets online. You're going to buy the tickets once you reach the cinema hall. So you have to buy the tickets physically there. But what do? You keep 1,000 rupees in your pocket. Now this 1,000 could be 2 into 500 or 500 into 200 into 5, whatever denominations you want to use, you use it. But 1,000 rupees is what you're kept in your pocket. You go to the cinema hall and you're at the ticket counter, your turn comes. You tell the guy at the counter, give me 2 tickets. And while he's printing the ticket, you put your hand inside your pocket to remove that 1,000 rupees. Again, to your surprise, you find that 1,000 rupees missing. But you have got a debit card with you, which you're carrying with you. So you can use the debit card to swipe and buy the tickets. Now, in this situation, tell me, how many of you will you watch the movies? If you're going to watch it, type yes. If you're not going to watch it, type no.
Okay. We are getting majority answers are yes.
Okay, absolutely. So now let's understand this very carefully. In both the situations, your loss was 1,000 rupees, correct? In the first situation, you booked the tickets online, you had spent 1,000, you did not have the online receipts, you had to spend 1,000 again. Second situation, you kept 1,000 rupees separately, that got lost, you spent 1,000 again. So the loss is the same in both the situations, but look at it, how our mind is responding. Your response in both the situation is absolutely different. In the first instance, you said we will not watch. Second instance, you're saying we will watch. Ideally speaking, if the situation and the loss is the same, my decision should also be the same. But this is not how it works. See how interesting and intriguing our mind is, right? And this is how it even works when we take decisions related to investments. So this is what we call as the mental accounting bias. Now, what is this mental accounting bias? Inside our mind or brain, we create buckets. And based on the source of the income, we decide what should be done. So let me give a very simple example. I'm sure many of you would be filing your income tax returns. Okay. So while we fill our income tax return, let us also assume that accidentally extra tax was cut. Okay. And you are now claiming a refund. So let's assume you claimed a refund of say 10,000 rupees. And the government is very prompt these days in giving back you that refund. So after 3 months, you get the refund of 10,000. Typically, you will find there's this 10,000 rupees which you got as a refund will be spent by most of us within a few days of we getting that money. Why? Because our mind says, "Was this is free money to me, right? Let me spend it the way I want it." But if you again logically apply, it was your own money which was deducted. It is coming back to you. So this is mental accounting. Second quick example: if you are salaried employees, you get bonuses. Now, what do we do with these bonuses? Typically, we go on a foreign vacation and we spend it out, or maybe we buy a bigger four-wheeler or buy a four-wheeler, etc. So typically, it's a discretionary expense that we do. Why? Again, the mind says, was this 2 lakhs, 3 lakhs which I have got? It's free. Salary is separate, bonus is separate. But why is this bonus paid to you? Because you have put that efforts in that entire year, then you're getting rewarded for that. But the mind says, based on the source of income, I will respond. Now, this in investments, which is going to benefit all of you. Okay. The simplest to do what is called as financial goals in life. For example, I have a daughter. She is currently 11 years old. So for me, a higher of 18. My own retirement at the age of 58. So which is under the say 20 years down the line. So when I make investments, I do a SIP for my daughter's education. I do a separate SIP for my own retirement. Now this is what I call as mental accounting. So in my mind, I have created two buckets. One is for my daughter's education. The second is for my own retirement. Now, typically what we find, especially with a lot of retail clients, is that people start their SIPs. But after a few months or few years, many of these SIPs are stopped or they are redeemed prematurely. Why? Because this mental accounting is not done. It is still lying in the general account. So you don't feel pinch, when you withdraw this money. But if I have these buckets, which is my daughter's education and my own retirement, very high probability that I will not touch these buckets to make those withdrawals or redemption. Okay, so always invest with your goals in mind. Take this mental accounting into your own this thing. So even though it's a bias, you can use it positively for your investments, right? Let's come to the third situation. Let's assume that you have made two investments on the same day. One is investment A, the second is investment B. In investment A, you had invested 5 lakh rupees, and the value of that investment today is 7 lakh rupees. Investment B, you have invested 10 lakh rupees. The value of this investment B is also 7 lakh rupees today. Now you need 7 lakh rupees. Which one will you redeem? A or B? A or B? A 5 has become 7, B 10 has become 7. You need 7 lakhs.
So the majority of the answers are B.
B. Okay. Now again, okay, B. That's fantastic. Now, typically, what I've observed in most of my sessions is that people tend to select A. Okay. Now, A, if you look at it, is a performing investment. It is doing well, right? And if you respond and say that I will redeem A, which means you are removing an investment which is performing well. It is like removing Virat Kohli from the Indian cricket team because he's performing almost every matches, and you're saying that, boss, Virat Kohli, I don't require you. Okay, you go out. But I am willing to give a player like Rishabh Pant additional chances. So he's young. Let me play him for another 5 matches, maybe 10 matches. He will improve. So when I select option A, which fortunately, and which it's a very good point, which I'm actually seeing here, that most people have selected B. Typically, I have seen people select option A. People who select option A is like removing Virat Kohli from the team. Ideally, you should remove option B, which is the investment B, because it's a non-performing investment, and both these investments were started at the same time, mind you. Okay, so typically when people select A, we call this as the loss aversion bias. So what is this meaning? I am seeing loss in my investments. And as human beings, our natural tendency is not to book these losses. Even if they are showing notionally as losses, I don't want to book these losses and take a loss into my account. That's called loss aversion. Now, how do we classify such investors? There are three categories of such investors. One, such people who are loss averse typically will hold on to a loss making investment for donkey years. So typically we find this in stocks. I have invested in some stocks. So typically 2007-8, a lot of people invested, including me, in what was the infrastructure stocks. This was the theme at that point in time. And after that, we know what has happened to these stocks. They have never come back to the levels of 2007. But majority of people would still be holding that infrastructure stock with them, despite the fact that it is 13 years since the investment was made. So you hold on to these loss-making investments for donkey years. Two, the loss-averse people are also like this, that I have seen some profit in my portfolio. I want to redeem that investment. Why? Because back of the mind, I'm worried that today markets are at high levels. Tomorrow if the market comes down, that profit will convert into lower profits and sometimes even into loss. So let me redeem the investment quickly. So today what we are witnessing is this kind of episodes. Three is what majorly is found in India. These are people who say, hey, is there a chance of a loss in mutual funds? Is there a chance of loss in stock market? If the answer is yes, then sorry, thank you very much, I'm not interested. Let me continue with my fixed deposits, public provident fund, etc., etc. So this is how a loss averse investor behaves. Now, why do we tend to avoid losses? Because when we feel a loss, okay, we feel pained about it. So when we incur a loss, we feel pained about it. At the same time, when we make profits, we feel very happy about it. But if you look at the magnitude of happiness versus the magnitude of pain, it is not the same. The pain magnitude is much larger as compared to the magnitude of the satisfaction or the pleasure that we get from a profit or a gain. That is why people tend to be generally loss averse in nature, right? Let's move ahead. Very simple question. What according to you is which according to you rather is the disease which has killed the maximum number of Indians in the year 2020? Just select your options. You don't have to write the name of the disease. You have heart disease, diabetes, diarrhea, COVID. Just select the options. And then let's see.
We're getting the answer as D. The most common answer is D.
Oh, that's right. So people tend to select COVID. But let me tell you, the right answer is option A and option B. So heart disease and diabetes were the number one killers in India last year, and they have been for so many years now. But why do people select option D, which is COVID? Interesting point to note. For the last 1 year now, all of us have been getting so many feeds every day about so many cases registered, so many deaths, so many recovery rates. Right? So every day we are bombarded with messages of COVID, COVID, COVID. whether it is print media, whether it is news channels, whether it is social media. Everybody is discussing only COVID. So this has subconsciously got registered inside our mind, and we feel perhaps that COVID would have killed the maximum number of Indians last year. Heart disease and diabetes is the number one killer, but they do not get reported every day. Maybe once in a year when there's a World Heart Day or maybe World Diabetes Day is the only day when you generally find some articles in the newspaper talking about heart and diabetes. But COVID, we have been discussing every day. Now, what do we call this in an investment parlance or from a behavioral finance? We call this as the availability bias. What is this availability bias? Whatever information is available easily to me, I take a decision basis that available information, right? Because I said, as human beings, all of us like to take shortcuts, right? And what is the shortcut? I can easily identify basis very easily available information. I can take decisions in investments. And more importantly, I give a lot of weightage to those information that is readily and easily available. Now, what are those kind of the parameters, which are easily available? One is the performance of a mutual fund. It's very easy to find out. Just go to Google, maybe, and type it out. I can get the name of the top 5 or top 10 schemes. Now, if I invest basis only that parameter, which means I'm basically relying on the past performance of the fund and investing in that particular fund. So this is how availability bias works. If I want to invest in a debt mutual fund, okay, the most easiest available information apart from performance is what we call as YTM, which is the yield to maturity of that fund. So I look at the YTM and I say, okay, this fund has the highest YTM, right? Let me go and invest in this fund. So these are easily available information basis which we go and invest. So this is availability bias. One classic example which I can relate to is when this entire COVID pandemic started happening. You must have received a lot of messages on social media which said that Fortis is charging 15 lakh rupees for 15 days. Some other hospital, somebody has spent 7 lakh rupees, 5 lakh rupees, etc. Now, India remains under-penetrated market as far as insurance is concerned, which means majority of people don't have a term insurance, majority of you don't have a health insurance. Now, the moment these kind of news started circulating, a lot of people said, oh, I don't have an insurance. Let me go and quickly buy an insurance. So that's availability bias. Okay, fair enough. Let's come to the last situation that I'm going to discuss today. I'm sure many of you would have seen this in your life. Now, let's assume that I have a 4-wheeler, okay, and I take my 4-wheeler out and I travel for about close to 1 kilometer and I reach the highway. So the moment I reach the highway, I find there's a huge traffic jam and my vehicle is stuck in the middle lane. There's one lane to my left, one lane to my right. 15 minutes pass. I'm still stuck in my lane. All the 3 lanes are absolutely immobile now. So I'm very frustrated inside. After 15 minutes, the lane which is to my left starts moving. And for next 5 minutes, this lane is moving. Now what do I do? I'm seeing that my left lane is moving. So I use all my driving skills. And somehow I take my vehicle into the left lane. Right? And guess what? The moment I reach the left lane stops. The middle lane where I was originally started moving, the right lane is also started moving. I'm sure many of us would have faced this, not just in driving, even while we are standing in some queue. So what do? I took a decision to change my lane basis what I observed right in front of my eyes and which happened immediately in front of me, right? So this is what we call as a recency bias. So I take decisions based on what has happened in the immediate past, in the immediate recent past. Now, typically, how does this work from an investment perspective? Now, what do? If I see that equity is doing well, so let's assume 2020, hypothetically, let's assume 2020, equity was the best performing asset class. So what do I do in 2021? I shift my money to equities, or I shift a majority of my money to equities, assuming that 2021 also equity will be the best performing asset class. Is there a guarantee? The answer is no. But let's assume 2021, gold happens to be number 1. So what do I do in 2022? Hey, last year gold was number 1. Let me put my money in gold. So I do what is called as lane changing, basis what has been the performance of the asset class. Even within mutual funds, I do this. If I invest in mutual funds today, I have invested in mutual fund A, B, and C, basis the performance of the fund today. After 6 months, these funds may not continue to be the top performing fund. So if I were a game changer, what I will do, I will redeem those investments, move to the next set of top 3 funds after 6 months. But if I keep doing this, I can assure you one thing, you will only end up paying transaction costs, you will end up paying exit loads, you will perhaps even end up paying capital gains. Okay, and this is a very dangerous thing to do in investments. So stick to your investment. Asset allocation is very, very important. There is no one asset class which will continue to be the number one asset class every year. We all of us know that equity is going to be the best asset class over the long period of time. But will equity be number one every year? The answer is no. And this slide tells us calendar year wise what has been the performance of various asset classes across different time periods, right? So we have understood some of these biases. I will only take next 2-3 minutes to quickly look at what kind of solutions can help us to come up these biases. Okay, I'm going to talk about very simple solutions. The first is goal-based investments. What are your financial goals? What is the time horizon for investment? Accordingly, you make an investment, do a SIP separately for each goal. So that takes care of your mental accounting thing also. Two, which is very, very important, is also what is called as asset allocation. Now, what is asset allocation in a very simple language? It is like this thali system. So you have rotis or chapatis, you've got two vegetables, you've got a pickle, you've got fried items, you've got two vegetables, one dal, etc., etc. You get proteins, you get carbohydrates, you get fat, you get starch, everything, but in the right proportion. So it's a balanced diet. Okay, that's important. Similarly, in your portfolio should be balanced. And how can I do that? I'm assuming, I'm making a very hypothetical assumption here that most of you might be having only equity SIPs. If you have got only equity SIPs, please also start considering debt SIPs in your portfolio. So typically what happens is when equity markets fall, it has been observed that the debt market as well. So if I have 100 rupees invested in equities, and if the markets were to correct by 10%, my 100 will become 90, right? On the other hand, if I have got equity plus debt, let us assume it is 80-20. So 80 rupees was equity, 20 rupees was debt. So this 80 rupees equity fell by 10%, so 80 became 72. Debt typically would do well. So let's hypothetically assume that 20 became 21, 5% returns in debt. So 72 plus 21, I am now at 93 versus 90 in equities. So I have fallen less as compared to a pure equity investment. That's the purpose of asset allocation. Asset allocation is not to maximize your returns, it is to minimize your volatility, it is to minimize your losses. Okay, so one example that I've taken is from the Axis table. We have a banking and PSU fund. Let's somebody would have done a SIP in this fund with 5,000 rupees every month, okay, since 2012. The investment would have generated close to 13% returns. So what I'm trying to say here is that not many equity funds would have delivered 13% returns in the same period. I'm not trying to say don't do equity investments. Equity is a must. It has to be done. But balance your investment with some debt portfolio as well, because that will take care of your asset allocation. It will minimize the volatility in your portfolio. You will stay longer with your investments. That's important, because if you don't stay longer with your investment, your end objective will not be met. Right? So let me just quickly summarize what we have done. We have understood that there's system 1 and system 2. System 1 is fast, system 2 is slow. There's a conflict, because of it there's a bias. And in investments, we have an emotional bias, we have a cognitive bias. We have looked at some examples, all of you have participated, you have done your own evaluation in terms of the biases. So the end result is that all of us are biased, right? And how can I come out of these biases? Very simple strategy: do goal-based investments and do simple asset allocation strategies, right? So this is what I wanted to cover today. Thank you all of you for your time, for your participation. Shikhar, over to you.
Yeah, thank you so much. Welcome back. Now I will talk about the product that Groww is, what we offer, what all our core strengths are, and so on. Let me just quickly share my screen here. Yeah, I hope it's visible. Yeah. So, as you all would have known if you've been using Groww for some time, or if you're new to Groww, then let me tell you. So, the reason why Groww was started, there are tons of reasons. There are many, many reasons. We can go on talking about those various reasons for a very long time. But if we have to summarize and keep it really short, the number one reason was to increase the awareness about different kinds of investment options that we in India have. In India, we usually observe that people are not aware about options like stocks and mutual funds, and most investors stick to FD and real estate and gold. So to make sure that all kinds of investment options are easily accessible to all investors was one of the reasons why Groww was started. Apart from this, transparency is another big core reason why Groww was started. We don't have a lot of investors in India don't have access to their own investments. They don't know what is happening. They are not able to track it, or even if they are, they're not aware of many hidden charges. They're not fully aware of how investments are working, if there is an exit load, if there's a commission involved. So to bring in this level of transparency is another reason why Groww was started. And the third reason that we often talk of is to bring a level playing field to the investment world in India. We observe that a lot of investors, if they have a lot of investment amount, if their capital is big, they get excellent service. Whereas smaller investors, people like you and me, people who don't have lakhs and lakhs to invest every month, we wouldn't get that high level of a service, or we may get and sometimes not get that level of service. So to bring a level playing field in the investment world so that everybody gets the same kind of excellent treatment is one of the reasons why Groww was started. Now, when you open the app, this is the first screen you will see. This is the login screen where you can log in with your Gmail, or you can log in with another email ID. We do your KYC. If it is not done, we do it for free. Everything is 100% paperless, and it all happens via your laptop or smartphone. When you log in, this is the first screen you'll see. So this is what we call the Explore screen. Within the Explore screen, there are three tabs. There's the Stocks tab, there's the Mutual Funds tab, and then there's the Gold tab. So in this particular screen, you're seeing the Mutual Funds tab. Here in the Explore screen of mutual funds, there are different collections, there are popular funds, all things related to mutual funds. Likewise, when you press Stocks, you will go to the Explore screen of Stocks, wherein you can see the Sensex data, top gainers, top losers, and various bunch of metrics and other information data that you as a stock investor might be interested in. Likewise, when you tap Gold, you will end up on this page, the Gold Explore screen, where you can choose from different digital gold options. As of this moment, we have Augment Digital Gold, and there will be other options in the future also. So now let's say you type, or you want to visit a mutual fund page, one of a particular mutual funds page. So that will look like this. This mutual fund page is of one particular mutual fund. In this case, it's Axis Midcap Direct Plan. In this page, no matter what detail of a mutual fund you're looking for, you'll find it all here. So be it expense ratio, be it how that mutual fund is performing when compared to other mutual funds of the same subcategory, be it the fund manager's name, everything is found on this page. Likewise, this is the stock page. So if you select a stock, you'll end up on this page. And on this page, you will find all possible data with regards to that particular stock. So it could be, again, P ratio, revenue, 52-week high price, and so on. And similarly, this is the page for gold, where you will be able to find all details about the gold option that you have. Now, one time or SIP. So in case of mutual funds, something we observe is a lot of investors are not aware that they can also do one-time investment. SIP is where, or SIP is where you invest regularly every month, but you also have the option of one-time investment. If you don't want to do monthly investments, if you just want to invest once, you have that option with almost all mutual funds also. And another misconception that a lot of people have that I would like to personally clear is that there's no limit to the number of investments you can make in a mutual fund unless specified, which is really rare. Most in the case of most mutual funds, you can start any number of SIPs you want. You want to start one SIP, that's fine. You want to start three SIPs, that's also fine. And you can do the other kind of investment while the SIP is running. So if an SIP is running, you can do a one-time investment in it also. If you are using a mutual fund only to do one-time investment, you can still start an SIP or more than one SIPs. It's all, every option is open. It's not like if one mutual fund you've started an SIP, you can't do a one-time investment in that fund. That's entirely possible. Now, this is the dashboard. Again, this is divided into three parts. There will be the mutual funds tab, there'll be the stocks tab, and there'll be the gold tab. So in the dashboard, what we display is your investments. So in case of mutual fund dashboard, you will see all your mutual fund investments. In case of stocks, you will see your stock investments. And likewise, if you tap on gold, you will see all of your gold investments. So in this case, you can see it's the mutual funds tab that we are on. Here you are seeing all the mutual funds that this person has invested in. And when you tap on any one name, you will enter a page where you can see more details about it. It's very similar to a passbook. You'll be able to see the average NAV, the folio number, and so on. This is what that page looks like. It's like a passbook. You'll have all the track records of how much you invested, how much you withdrew, what date, which date, and so on. And right at the bottom of that page, you have this option, which is invest or redeem. So you can, if you want to invest more in that mutual fund, you can tap on invest more. Or if you want to take out, excuse me, if you want to take out money from that mutual fund, you can press sell, which is the same as redeem. And you enter the amount you want to take out. And within one or two taps, it'll be confirmed. And the money will reach your bank account based on which mutual fund it is. There might be some mutual funds, some, not all, very few mutual funds have a lock-in period. So in case of those, if you're within the lock-in period, you will not be able to take out the money. But in most other cases, you can easily take out the money. Now, you have all sorts of payment options on Groww. You can use UPI apps, net banking, NEFT, RTGS, IMPS, it's all available. Now, import and switch. So this is actually a very, very, I'd say, popular feature on Groww. What import allows you to do is, in case you have investments outside of Groww, you would have made investments using some other platform or via someone else. And now you wish for it to be available in one place on Groww, on the Groww app in your dashboard. This is that feature that allows you to do that. So you can have all your mutual fund investments, no matter where you invested it, you can have them on your Groww dashboard. It's very easy. It's very smooth. It's seamless. Just go to the dashboard, scroll all the way to the bottom. There you'll see the option import. Tap on it. There'll be a few things that you'll have to submit, and then you'll be done. You'll be able to track, or rather import the mutual funds to your Groww dashboard. Now, this feature, which is called the switch, allows you to change the plan of your mutual fund. So let's say you've been investing in the regular plan of a mutual fund where you are paying commission, and you'd like to stop paying commission and switch to the direct plan. This switch feature allows you to do it. So first you have to import the mutual fund to bring it on the Groww platform. And once it is on Groww platform, you will be able to see the switch option there, using which you can change that mutual fund from the regular plan in which you are paying a commission to the commission-free plan, which is also called the direct plan. If you have any questions, any queries, any doubts, please reach out to us. Our email is support@groww.in. Besides this, I would highly encourage you to use the help and support section on our app and website. Most of our users are able to find a resolution to their doubts on help and support. If not, there is the option of raising a ticket via help and support, via which you can chat, email, or even call us. So I encourage you to use those options. And we are always here to answer your questions. So please email us at support@groww.in. Please also follow us on Facebook, Twitter, LinkedIn, and YouTube. If you are a new investor, you might find our YouTube channel very helpful. Jagdeep Singh uploads around 3 to 4 videos every week about investments. He tries to cover stocks and mutual funds. So if you're new, you will definitely find this channel resourceful. A few more things about us. We're one of the highest rated investment apps in India. We have practically every mutual fund in India on our platform. We have over 1 crore users. We are SEBI and AMFI registered. We use 256-bit encryption, and we are a ISO certified company. That's it from me. Now, Mr. Hariiharan and I will take questions from you all. So whatever questions you might have, please leave them in the comment section, and we'll try and answer every one of them. Yeah, so let's go with the first one. Nifty and Sensex are at all-time high almost every day. Will it correct majorly?
Okay, so this is a very common question that we keep getting over the last, I think, 1.5 to 2 months. Now, let's first understand why is it that the markets are going up. Okay, so there are a few factors that have played their part. One is clearly that if you look at the GDP of the country, even though we have negative GDP growth the last 2 quarters. So when the COVID thing happened, the quarter 1 was a complete washout. We had minus 24% GDP degrowth. Quarter 2, a lot of people estimated that it would be minus 10, minus 11%. Fortunately, it came at close to minus 7.5%. Even though it was negative, this was a positive sign because from minus 24, we have come up to minus 7. Okay, so that's a positive trend. 2, economic activity has started. Okay, by and large, everything is now fully functional. 3, what has also happened is the COVID cases have come down in India. People might debate whether it's not reported, etc. There's a vaccine that is now formally announced. A couple of those vaccines will be available for usage. And all these are factored into the market sentiments. Another important factor that has favored is that the corporate profitability has gone up. Okay, and this is happening after quite a significant time period. Every time people were talking of this quarter will be better, this quarter will be better. It never happened. This time the quarter results have come out very well, Q2 results, and that has worked in favor of the equity markets. There's also enough liquidity in the market. Okay, please understand there's enough money flowing into the markets, and all this is taking the market to a high level. Now the question is whether Nifty and Sensex will continue to go up or will it come down. The frank answer is nobody knows about it. But the assumption that is now being made is that because the liquidity would continue perhaps for a few more months is what is anticipated, because there's so many countries which are running negative yields, which means that money is going to flow into emerging countries like India. 2, even in India, if you look at it, the Reserve Bank of India has cut rates. Today, we are in an environment where interest rates are at very low levels. Perhaps these kind of interest rates were not there for the last 40 years. Now, when the interest rates are lower, it helps corporates because the profitability can improve, especially the mid-sized and the small-sized companies. So large-cap companies and big companies were not severely impacted by COVID. But they were resilient enough to handle those situations. But the biggest impact happened in the mid and the small cap companies, and they really found it very difficult. Hopefully, with the low interest rate environment continuing, RBI has very clearly told that at least till June 2021, the rates may not be hiked. So this environment could continue, which means liquidity could remain. But the flip side of this is that if the liquidity moves away, so let's assume US increases the interest rate, then there could be some amount of liquidity outflow, which would result in some minor correction to the tune of 5 to 8, 10% kind of corrections could happen. So frankly, nobody knows, but both these possibilities exist. Okay, hopefully if things continue, we don't get the new strain of vaccine, or sorry, the COVID could also be a deterrent if the economy does not go into standstill. If it continues to be operational, we assume that this trend might continue mainly because of the high liquidity that is coming in. Okay. So my very sincere request and suggestion is don't look at absolute values, 48, 46, whatever it is. Every time Sensex has crossed a milestone, whether it is 20,000, 25, 30, it was the lifetime high at that point in time. But those have become irrelevant today. So these are a couple of things that could work out. Atmanirbhar project is another project that the government has introduced, which again could add significant value to the economy in terms of job creation. And if people earn income, they will also spend. India happens to be a spending economy in the terms of GDP composition. So our consumptions contribute close to 60% to the GDP. So if that happens, that should also add significantly to the GDP. So hopefully these parameters, if they continue to do well, we might see this rally continuing and sustaining for some more time, right? And therefore, this is what my suggestion is, right?
Great. So we have the next question for you, which is, what should we prefer to invest more in, equity or debt?
Okay, now this clearly is dependent on your time horizon of investment. What are your financial goals? So if you do risk profiling, essentially what it means is that if I analyze what kind of risk I can take and what is the time frame of investment, I can decide by asset allocation, which is what should be the mix in equity and debt. The thumb rule says that 100 minus age should be equity. So if I'm 40 years old, 100 minus 40 is 60. So my exposure should be 60% into equity. But these are thumb rules. You cannot just blindly apply them. It is important for you to identify what time frame is also there. So if you want to invest for 10 years, 15 years, 20 years, then your equity component can continue to be high. But if somebody wants to invest for say 1 year, 3 years, then equity may not be the right option. You will have to look at the debt investment, maybe get into debt mutual funds. So this purely is dependent on the individual in terms of your risk-taking capacity and the time period of investment.
Okay, thank you. The next question is for me. What is the difference in investing one time and SIP, and which is more profitable? Okay, this is, so you have, let's say, a sum of money and you invested today. And let's say you sold a house, you earned some real estate property, you got some large amount of money. If you just put it in the market, if you just invest it, it's called one time, right? You just invested it, there's no obligation to do it again, none of that. In SIP, what you do is, SIP is regular investment. So every single month, you choose the mutual fund you want to invest in. You choose the date on which you want to invest in every month. So like, for example, you can choose the 3rd of every month, 3rd of May, 3rd of June, 3rd of July, so on. What will happen is, on the SIP date, the amount you have chosen, that amount will get deducted automatically from your bank account and will get invested in the mutual fund of your choice. Okay. You can cancel an SIP anytime you want. It's basically automating an SIP. Okay. Now, there are the main difference is that one is regular every time. For example, if you're earning a regular amount of income, SIP is good because as the money comes, you go on investing it and it's automated, so you don't have to worry. If you have a large amount of money, then you might consider one-time investment. But now the second part of the question was, which is more profitable? Now, there is no thumb rule to tell you which is more profitable. I can tell you there's a slight risk reduction when you're investing in any mutual fund via SIP. So let's say you make a one-time big investment in any mutual fund, and right after your one-time investment, there's a big fall, right? So you could suffer some unrealized losses. You haven't made those losses, but the value has gone down, right? So to prevent this risk, many people systematically invest, even if they have a large amount, they invest it over a period of time, 6 months, 10 months, 1 year, something like that. They will invest it gradually and spread out that risk. So that averaging out the risk is one benefit of systematically investing every month. Uh, which is more profitable? Now, this would entirely depend on what time you make the one-time investment. There have been times when making a one-time investment proved to be smarter, and there have been times when it proved to be disastrous. And again, this has been discussed in the investment world a number of times. We don't really know, nobody really knows how to time the market. It's not something many people have a good track record of doing. So, in that sense, it would make sense to always, no matter what amount you have, to try and opt for a systematic investment instead of going for a one-time investment, at least in equity funds. Debt funds, I think it's reasonable to say you can invest one time, but if you're investing in equity, it makes sense to go with a systematic approach. If you have the large amount already with you, please explore this option called STP, Systematic Transfer Plan, in which you invest one time the large amount in a debt fund and gradually move it over a certain period into equity funds. Investing one time large amount in equity fund is usually not a good move, simply because of the risks involved. I hope that answers your question. Okay. What mental models should an ideal investor have? That's a question for you.
So I don't get this question. What does it mean by mental model? So if I were to sort of just take a wild guess, what the question is, essentially, as I said earlier, also it has to be your asset allocation. It has to be your goal-based investment. These are two thumb rules, or formulas which can help you achieve your financial goal and become very wealthy and create a lot of wealth for yourself. I hope this answers. I'm not too sure what the mental model is. I am just making an assumption that this is what it is.
I think the viewer meant which mental models they should adopt while investing, and I think those are some of those you covered when you were talking of the bias, the kind of mental models you have to keep in mind while fighting your biases, maybe.
Correct. So the way to do it is to avoid the biases is just to goal-based and asset allocation. These are two practically implementable strategies that one could look at to avoid these biases.
Okay, great. So the next question is, next two questions are for me. How can we increase the SIP amount? As I have said many times on AIKI, Ab India Karega Invest, the option to increase your SIP amount is at present not available on Groww. What you can do is you can start an additional SIP in the same mutual fund with the increased amount, or you can cancel the existing SIP and start a new SIP with the increased amount in the same mutual fund. The next question is, Mr. Hari, is it good idea to invest in IPO?
Okay. So typically, again, there's some amount of biasness that comes, when it comes to investing in IPO. So especially when markets are in the bull rally, you will find a lot of companies also bringing their IPOs because they feel this is the right time to get money from the public. I said there's enough liquidity in the system, so all this liquidity can be diverted to IPO kind of stuff. My sincere suggestion and request, I'm not an expert on IPOs because one, we are not allowed to invest in IPOs personally, so I don't do too much of research, but I would suggest that if the business makes sense in the sense that it's a really good kind of investment. So for example, tomorrow there's a company which comes from a disruption theme, just a hypothetical example, okay? Don't go by what I'm saying, just to give you an illustration. Say tomorrow a policy bazaar, or tomorrow maybe Uber or Ola, these kind of disruption themes, they come out with their IPOs. Then I think these are really relevant because the entire world is moving towards digital, and these are companies which could dominate the next few years in the stock markets. Okay? These are just for illustration purpose, just to give you the perspective of what kind of IPOs one should look at. Be very wary of the fact that when there's a bull rally that happens, most companies want to get the money from the capital market. So it's a very easy route to get money. So be very watchful and careful that you just don't blindly invest in all IPOs that come across. Okay, we have seen enough instances, and this also is a bias. Okay, that people tend to invest only in IPOs. And there have been enough instances in the past where people have invested in IPOs. Out of 10, 3 have done well, 7 have not done well. So be very, very wary of it.
Right. Thank you for that answer. The next question is, what should be one's investment plan to purchase a 3 BHK home in 10 years?
Okay, 3 BHK home in 10 years. So one is that since there's a 10-year time horizon that's available, there are two routes that you can use. I'm making an assumption here that you would also take a home loan. So some part would be down payment, and this is what you essentially plan for. The other part would be funded by the bank. So for your down payment, assuming it's going to be a down payment kind of thing, since you've got 10 years, there are two ways of doing it. One is you go full equity, okay, or you do equity for 7 years and then shift whatever amount is accumulated into debt, because you don't want to take a chance in the last year of your buying the house. You know, if the markets go to tank by 20%, then your entire effort of 9 years is gone wasted. So the way to do it is plan 7 years equity investments. Whatever is accumulated, shift it to equity, shift it to debt for 3 years, where it is relatively safe. You're not exposed to the vagaries of the market. That's one way of doing it. Second way is you do a asset allocation right from day one, which is mix of equity and debt for the entire 10 years. My preferred choice is do 7+3 kind of combination, equity for 7, 3 for debt. So it's a reverse calculation that you end up doing.
Right. Great. The next question is actually for me. Delivery holding charges on Groww. Okay, so with regards to any kind of question that is pertaining to charges on Groww, I would highly encourage you to go to the page groww.in/pricing. Here you will find all details about charges on Groww. I will very quickly tell you the three main charges. Account opening is 0 rupees. AMC or account maintenance charges is 0 rupees, and brokerage is 20 rupees or 0.05% per executed order, whichever is lower. Okay, so that those are the primary ones, and for other, there are many other smaller taxes and those things involved. Please visit our page groww.in/pricing. Right. So with that, we come to the end of our Ab India Karega session today. Thank you for joining us. I think this was one of those topics that I personally love talking about, and I'm sure all our viewers also enjoyed listening to you on this topic.
Thank you. Thanks, everybody. Thanks, Groww, for organizing this.
Thank you.
Thank you.